Some types of depreciation methods are known as declining balance methods. And double declining balance is the most popular one probably. And basically it's going to be taking higher amounts of depreciation, so higher depreciation in the asset's early years. So right when you place the asset into service, years 1, 2, and 3, that's when you're going to have the highest depreciation. And then as the asset is older and basically getting close to being put out of service in those later years, you're going to be having lower amounts of depreciation. And basically that's reflecting the fact that a lot of assets would be more productive basically when you first get it, and then as over time you're actually spending more money on maintenance and so forth in the later years as the machine becomes less productive. So how do you calculate double declining balance depreciation? Well, you're actually going to need to put, it would be helpful to put together a little bit of a schedule. And I'll just go ahead, let's use the example that we used in our straight line depreciation video. Let's use an example of a pizza oven. So you have a pizzeria, you buy an oven, and you estimate that the useful life of this oven is going to be, let's say, 5 years. And then the cost, the purchase price of this oven, it costs you $50,000. And you estimate that the residual value, the salvage value, is going to be $4,000. So that's what the asset's going to be worth when you're done depreciating it at the end of the 5 years. So let's put together our schedule. I hope I've left enough space here. Let me just put a little divider. So we're just going to organize it. We'll say year. So year, and then in terms of year, we'll have year 1, 2, 3, 4, and then our fifth and final year. Then we're also going to need the beginning book value of the asset. And I'll just abbreviate this BEG BV, beginning book value of the asset. And then we're going to need to know the depreciation rate. I'll talk about that in a moment. And then the depreciation expense we take every year. That's okay. And then we're going to need to know the running tally of accumulated depreciation. And then the ending book value. I apologize, this is a little cramped here, but these are the things we're going to make it really easy for us to go ahead and calculate our depreciation each year. So the beginning book value, that's just going to be our cost of the asset, which is $50,000. Now notice, we do not adjust for the salvage value here of $4,000. So it's not like straight line where we take the $50,000 and deduct out the $4,000. That's not what we're going to do. And actually, when we depreciate this, our ending book value, what we're going down to, that's going to be that $4,000. And I might as well, I'll just write it down right now. So that's where we're accounting for ultimately the salvage value. But our beginning book value is unchanged. That's $50,000. Now, this rate is very important. So to figure out the rate, basically we say, okay, well, if we were doing straight line, what would, and here's this SL, if we were doing straight line, what would our rate be? Well, with straight line, we'll take this asset and assume we had 5 years and then just the $50,000. Basically, ignoring the salvage value for a moment, basically we'd just be depreciating this asset at basically, let's see here, so 50,000, we'd have 50,000 divided by 5. So we're taking 10,000 in depreciation each year under straight line. So 10,000 divided by 50,000 to get our rate, to convert that to a rate, we're basically, that's 0.2 or 20%. So what does that mean? That means that under straight line, assuming we ignore the salvage value for the moment, basically we depreciate this asset at roughly 10% of its, or excuse me, 20% of its value every year. It would go down. We reduce. So you say, okay, it's 50,000, so 10,000 every year, or 20% of the asset's initial value every year we're taking. That's how much we're depreciating it. The asset's depreciating 20% each year of that initial value of $50,000. So we just double that to get our double declining balance rate. So we just say, okay, this 20%, we'll just take twice that, so it's 40%. Let me change back to blue here. So 40%. Now, in truth, you could choose any rate you want. I mean, a firm could say, well, we wanted our declining balance method to be triple, or whatever. So in any event, in this case, we're just going to go with 40%, which is roughly double what it would be under straight line. So now we need to figure our depreciation expense for year one. So what do? We just multiply the beginning balance by the rate, and that's going to give us our depreciation. So that first year, we're going to have $20,000 of depreciation expense. Now compare that to what we would have had under straight line. Under straight line, we just calculated we would have had $10,000 every year. And here we've got $20,000. So that's a lot more depreciation, and that reflects the fact, again, that in these early periods, we're actually going to be taking more depreciation than we would in the later periods. So the asset's depreciating faster. So our accumulated depreciation, well, that just starts at 0. So we add in this 20,000, and it's going to be accumulated depreciation of 20,000. Now our ending book value, so we say, okay, well, we started with a book value of 50,000, and now we have accumulated depreciation of 20,000. So picture a mini balance sheet. We're going to have the 50 minus the 20. So that's going to give us an ending book value of 30,000. So now our ending book value for year one is going to become our beginning book value for year two, right? So just take this 30,000 and it'll come over here. Now that's our beginning book value of year two. So now we just go ahead and take that same rate. Let me just erase this here. We take that same 40%. That's just going to be 40% every year. I can actually just write that down here. Every year, we're going to be having that 40%. So the rate is constant, but now the base against which we're charting it is different. It's lower now. It's 30,000 times this 40%. So that's going to give us depreciation of 12,000. Okay, that's just simply the 30,000 times the 40%. That's all that is. That's 12,000. Now this 12,000 is going to get added to that 20,000 to get our running balance of this accumulated depreciation, right? Because we took 20,000 depreciation here, 12,000 here. So we need to add them, and that's going to give us 32,000. That's our running tally of accumulated depreciation. Now our ending book value, we say, well, what's our book value? Well, remember, the asset was basically $50,000 asset, and now we have accumulated depreciation of 32,000. So we just net those together, and that's going to give us 18,000. So that's just the 50,000 value of the asset minus 32,000 accumulated depreciation. That gives us that 18,000. Now in year three, we again just take the ending book value of year two. The end of year two is the beginning of year three. So now we just take that 18,000 and plug it right in here. Now we're going to have depreciation expense of 7,200. And again, we just multiplied 18,000 by that 40%. And now our accumulated depreciation, now we've got 20,000, 12,000, 7,200. We've got all of this. So now we're going to have 39,200. And then when we think about our ending book value, we just say, okay, that 50,000 minus the accumulated depreciation. Okay, so that's going to give us 10,800. I hope I'm not writing off the screen here. And now 10,800 is going to be the beginning value of year four. And we just multiply that. And then now that's going to give us depreciation of 4,320. And then our running accumulated depreciation will now be 43,000. I'm going to try and squeeze this all in here, 520. And then our ending book value is going to be 6480. Hope you can see that. Now, 6480 becomes the beginning book value in year 5. We again multiply that by our rate of 40%. Now we've got an interesting situation here, because actually our depreciation expense that this gives us is 2592 when we multiply this out. But we have a problem, because if we take this and multiply and take that 2592, we would actually have a book value. We would end up would be less than 4,000. But we know that that's our salvage value. We can't go below that. But if we took this, we'd have the ending book value of, I think it'd be 3888. It'd be less than 4,000. So we can't have that. We have to stop at 4,000. So we basically cap this and say, okay, well, we can't do this 2592. What we have to do is 2480. That's the most depreciation we can take, because we can't go below our salvage value of 4,000 for our ending book value. So the 2480 is like, this is capped. This is capped. And so then that also is going to affect our accumulated depreciation, which will just end up being 46,000. And basically we end up with the ending book value, which is the salvage value of 4,000. Now you might be thinking here, well, wait a minute. What if we had a situation where the double declining balance actually didn't fully depreciate, didn't get us to this salvage value of 4,000, right? What if, for example, our salvage value, and I'm just going to change around some of the numbers here. You can go back in the video. Let's say that our salvage value, instead of being 4,000, and I'll erase this too. Let's say that the salvage value was 0. Okay. Let's say that the salvage value was in fact 0. This asset will be worthless at the end of 5 years. Well, now we're trying to get down to 0. And so now we've got, instead of this capped amount of 2480, we've got the 2592. And then this isn't valid anymore. And now we end up with, I believe it was 3888 as our ending balance. But hey, we're supposed to be depreciating it down to 0. But because we're just taking 40% of some number, it's not guaranteed always that double declining balance will get you to whatever your salvage value is. Now, in the first example, we had to kind of actually take less depreciation, and that to make sure we didn't go below the salvage value. But in this case, we don't even get to the salvage value because we're at 3888, and what we really need is 0, right? If we don't have any salvage value in that kind of context. So then you might be thinking, well, what do you do? Well, one thing that some firms can do, they can say, okay, well, in like the last period or in the last couple periods, what have you, they might say, well, we'll actually say, okay, we'll take the larger of straight line or double declining balance, right? So in that case, you'd say like, okay, well, 10,000 would have been what it would be under straight line, assuming for a minute we don't think about, well, in this case, we don't have a salvage value, so we don't have to think about that, but it would be 10,000. Obviously, we can't take 10,000 because the beginning book value is 6480. So what you would end up doing is just taking the full 6480 as depreciation to make sure that the asset is fully brought down to 0.